Are you feeling generous today? It's tax time and we're going to talk charitable contributions. So here's the problem. The problem is you're giving to charity, right? Maybe you've got a small mortgage payment, your property taxes, state taxes are limited to $10,000. You don't have enough to itemize. So you use the standard deduction every year, whether you're married or single. So in other words, those charitable deductions don't even help you. Here's a way to bunch a whole bunch of charitable deductions in 1 year, but yet give to charity over multiple years. It's called a donor-advised fund. It's a pretty cool strategy, and here's how it works. Essentially, you take some of your non-retirement assets, generally cash and stocks, could be other assets, and you give it to this donor-advised fund. So that's a special account that you set up. It's designated for charity at some point in the future, but you're the trustee. You get to designate where these gifts to charity go. You get an immediate tax deduction, and then you get to decide which charities get which amounts at any time that you want. So here's an example. Typically, let's say you give $5,000 a year to charity, and when you do that with current tax law, you still don't have enough to itemize, so you're getting no benefit whatsoever for that. So here's a way to bunch all these up into one deduction. Maybe you want to take the next 10 years. So you give $50,000 to a donor-advised fund, and then each year for the next 10 years you give $5,000 to charity from that fund. But here's what happened. The year where you set this fund up is the year where you get the tax deduction. That whole $50,000 becomes a tax deduction. When should you do it? Well, it's not really that tricky. You do it in a year where you have very high income, right? Because you want to lower your tax rates. You get the tax deduction in the year that you want it. You're able to itemize your deductions, right? And then you give to charity over time. And there's no minimum or maximum. You can give as much or as little as you want. You don't have to give anything to charity in the next year, or you could give the whole thing, whatever you want to do. Here's one more quick tip. If you give stocks or mutual fund, you can give that right to charity. Your tax deduction is what it's worth on the date of the donation, but you don't have to pay the taxes because it goes directly to charity through the donor-advised fund. If you give cash, you've already paid taxes on that. So if you give appreciated stock outside of retirement accounts, we're only talking about non-retirement accounts, you get a double benefit, right? You get a charitable deduction, and you get you don't have to pay capital gain taxes. So once you understand this and realize how powerful it is, I think many of you are going to want to implement this strategy. At Pure Financial, we have advisors that are ready to talk to you about taxes, and I love to talk about taxes, and so do they, but we all hate to pay taxes. That's why we have a free tax reduction analysis, and you can schedule your appointment right online.